All right, guys, welcome back. Welcome back. So this is going to be a finance video. If you're here for my stocks and you know how credit cards work, feel free to click off of here. This won't be pertaining to stocks at all. If you're here for personal finance, this is what we're going to do. So we're going to talk about how credit cards work. So when I started out with, my adult life, I didn't realize how credit cards work. Like, I got the gist of it, right? You charge your card and then the bill is due and you pay the bill and then you get to charge it again, right? Because it's known as revolving debt. Okay, meaning revolving debt is once you pay it off, you can use it again. Okay, it just revolves. Your balance just revolves, right? But I didn't know the intricacies of all of these terms that we're going to discuss today, the major terms. Okay, and because of that, I got into a little trouble with credit cards when I was 18 and 19. I'm 35 now. But had I known this stuff and had I known, what a powerful tool credit cards are, if used properly, it would have accelerated my financial life, I guess you could say. And I wouldn't have struggled as much as I did in my mid-20s while I was trying to repair what my 18 or 19-year-old self did. So I'm just being totally honest with you guys. So the reason I know this stuff is because I messed up and I had to learn how to get out of it, and I had to learn how to not mess up again. So we're going to go through this, how credit cards work. And what amazed me was that I think I'm a pretty, intelligent person. I didn't know this stuff, like I said, but what I've noticed is that until you, and maybe they do this now, maybe they teach personal finance in high school, but the high school I went to, they did not. So I didn't get to take a personal finance course until I went to college. And, all this stuff was in there, but they still didn't really go as deep into it as I'm going to go into it right now. And as a consequence of that, most people don't know how this stuff actually works. They don't have a detailed analogy of how it works. So what I'm going to show you today is how it works. I'm going to show you how to calculate quick and easy how much interest something's going to cost you if you want to carry a balance on it. And that may, sway you from, making that purchase if you can't afford it. And I'm going to show you how credit card companies basically keep you in debt. Now, what I want you to take away from this, though, is that credit cards, like anything, they're a financial tool. Okay, I know some people that are terrified of credit cards. They won't use them because they don't trust themselves, or they won't use them because they don't understand them. So they're just afraid of them. And that's the worst thing that you can do to yourself, because when you don't have credit in the real world, in the adult world, you don't have anything. Okay, and there's people that, they make so much money they can pay cash for everything. But I have a friend right now, makes over $100,000 a year, finally, and he can't buy a house because no bank will give him a loan because he has terrible credit. Okay, so cash is trash. You need it, but you also need to pair it with good credit. And credit cards are one of the ways that you're going to build that credit up. So you have to understand how they work. They're essential to getting the things you want out of life: a car, a house, any loan for a business. They're essential because they're essentially your reputation in the financial world. Okay, and I'll make a video of how credit scores work too, but we're going to start here. So how credit cards work. Okay, so like I already said, we know that credit is money lent to you by a bank or a lender. And what's important to understand about credit is it's future money. Okay, it's future money. Okay, you don't have the money today. Okay, so you are pulling your money from the future forward to today. Okay, you're reaching into the future. Okay, and pulling your spending forward. Okay, so this is really important to understand. So I'm gonna spend a little bit on this. When you have money today and you spend it, okay, you don't create a credit balance. You don't owe anyone anything. Okay, what credit allows you to do, though, is it allows you to spend the money that you have today and the money that you're going to have tomorrow or next week or next year. Okay, so what it does is it increases your buying power. Okay, it increases your buying power. So your buying power goes up. Okay, now this is okay if you feel that you're going to get a raise, or you're going to produce income, or you're going to do something with this money so that when tomorrow comes, you have enough money to repay this buying power that you pulled forward to today so you could get the thing that you wanted today. Okay? And that's really the trap. Okay? That's really the trap that keeps people poor, because they get a credit card and they're just swipe, and it goes through, and then the bill comes. Okay? And what you wanted that day, what you wanted today, are you going to want the same thing tomorrow? Probably, but maybe not if you knew how much it was actually going to cost you, right? So what it costs you is peace of mind, okay? And that's what we're going to get to here. So, but think of it this way. Credit is just future money, okay? When you use credit, you're promising to pay them back more money tomorrow than you have on you today after a certain period of time. We'll get to that. That's grace period. That's next, okay? You're saying, okay, give me this money today so I can buy what I need. Maybe I'm getting a deal on it. Maybe I don't want to pass it up. And I'll have the money tomorrow, whenever that tomorrow is, whether it's 30 days, 20 days, whatever it is, you're going to have it. But you're increasing your buying power today because you don't have the money. Okay? So just understand that part about credit. It's basically a bill for your future self. Okay? So whenever you swipe your credit card, you need to think, is my future self going to enjoy paying for this bill? Am I today, the person I am tomorrow, going to be mad at this person that I am today because they made a decision for me and made me liable for something? So that's how you should always be thinking of everything, whether it's retirement or whatever, but that's off topic. Okay, so we're going to go to grace period now. Okay? The grace period is something that credit cards give you. They loan you a specific amount of money for a specific amount of time, and they give you a time to pay that bill. So a typical billing cycle, we're going to keep it simple. We're going to pretend every month has 30 days. I know every month doesn't, but we're going to just say that it does. So say on the first 30-day cycle, this is going to be your statement balance, okay? Your first 30-day cycle, okay? Let's say that somewhere in here, let's say on the 5th, you spend $10, and over here you spend $10. This is the 15th. On the 20th, you spend $10, and then on the 27th, you spend $10, okay? This is month 1, okay? First month, okay? At the end of this 30-day period, you are going to get a bill, okay? You're going to get a bill at the end of this 30-day period. Typically, your bill is not going to be due until 20 days after until 20 days after your 30-day statement date. So we're going to plus 20 days to this, okay? So from day 30 to day 50 is when you have a chance to make a payment. Your payment is going to be due on day 50. It's the absolute latest that you can pay it to avoid interest on the money that you borrowed, the 10, whatever, okay? So this period of time here between day 30 and day 50, this is called the grace period, okay? They calculate how much money you spent this first 30 days. They send you a bill on day 31 or 32, and from the time you get that bill, you have 20 to 25 days, some of them are a little more lenient. You have 20 to 25 days to pay that bill. If you don't pay that bill by your grace period, okay, or you don't make a minimum payment, which we'll get to, that is when you're going to be charged a late fee. Okay, but let's handle the minimum payment first. Okay, so on month 1, you are charged, you're charging all this stuff. You're not being charged interest on this right now. Okay, this is basically free money. Okay, if you've got money sitting in a bank account. You can use that money to do other things with, pay other bills. If it's earning interest, it can continue to earn interest. But you're not being charged money during this first month of your statement period. Okay? You're also not being charged interest during this 20 to 25 days that they're giving you to pay your balance. Okay? Okay, so you get your bill, you have your statement balance, and your minimum payment is going to be, typically it's usually $25 or 1% of your balance, okay, whichever is greater. So if 1% of your balance is not more than $25, you're going to pay the $25, okay? If 1% of your balance is more than $25, you're going to be charged the 1%. Okay? Does that make sense? And this will make sense later. I got a spreadsheet coming up for you guys to visualize all this, okay? So if you don't make this minimum payment by your due date, which is your 50th day, so you made these purchases a long time ago, you don't make this minimum payment, you're going to be charged a late fee. Late fee is really simple. You were charged a late fee because you didn't make a payment at all. You did not do anything with the balance. They charge you a late fee. Now, late fees are terrible for two reasons. For one, they go on your credit report, they lower your score. For two, they're usually huge. They're usually like $39, $40. I've seen $50 fees. I think the government capped it recently. I don't quote me on this, but I think that they capped it. But when I was in trouble, I saw some of these fees. I think they're capped here though. Maybe for the first time, and then after so many late fees, they go up. So maybe they go up to 60 or something like that. But don't hold me to that. But I know something happened with how many fees they could charge you. But after that, they get to charge you a higher interest rate typically also. So if you had a nice credit card interest rate, and by nice, we'll just say average, say you paid 15%. Once you miss a payment, you get charged a fee, okay? And then they also get to bump this 15% up to like something outrageous, like 39.9%, okay? So very important that you make at least the minimum payment if you can't do anything else, because that'll keep you out of this cycle here. Because once you're in this cycle, it's really hard to break free. Okay? So let's backspace a little bit here. It's getting a little clunky. Okay? So after the minimum payment, so you have two choices. You can pay your entire balance off. You can pay off everything that you spent here. Okay? Or you can make the minimum payment. Now, if you choose to make the minimum payment, if you spend more money, okay, yesterday than you did, you're going to have what's called a balance. You're going to owe them money. You're going to carry a balance, okay? And this is a really terrible thing to do. That's why you never want to spend more money and carry a balance than you can afford to pay back when the bill is due. Because what the balance does is two things, okay? Notice how you spent your first month, between the first and the 30 day. And remember I told you that you weren't being charged interest on this at the time that you spent it, right? So when you decide to carry a balance, you make a minimum payment on day 50. Well, what's day 50? Well, day 50 is month 2, and you're 20 days into month 2. Okay? So day 50, this is day 50 right here. You're already into month 2. This is your second month. So what happens to all the money that you're spending in month 2? Well, if you carry a balance, guess what? This money here that you're spending, so you spend the same amount, $10, $10, $10, all of this you're being charged interest on immediately because you have fallen from grace. And that's what I like to think of it. You have fallen from grace. Okay? They gave you 20 extra days to pay what you spent the first 30 days. When it got to day 50, everything that you have spent in this period from 30 days on, okay? from 30 days forward, you're now being charged interest on every single day. Okay? So think of how terrible this is when you miss a payment. You get dinged with a late fee. $39 late fee. They get to raise your interest rate. It goes from 15 to, let's say, a 40% interest rate. Okay? Because now they're putting the brakes to you. Now you're risky. Okay? Now they're costing, it's making them nervous to let you use this card. Okay? So they're going to charge you more money for the privilege of using their money. Okay? Because now you've made them nervous. You spent more than you could pay back. You didn't pay them back. You were late paying them back. They'll charge you this, and now you're being charged interest on all of this money back here. Okay? So we're going to see how this cycle develops. Okay? So what you want to do every month is if you spend 10, let's say you got $40, okay? Don't make a $25 payment and owe $15. Even if you owe $1, guys, if you carry forward one stinking dollar, you give them all but $1, you're still carrying a balance. Okay? How do you get back to the grace period state after carrying a balance? You have to not have a balance for 2 months, for 2 cycles. Okay? So month 1, month 2, at the end of month 2, if you pay them off here, okay, you have to wait this entire cycle of month 3, from the 60-day to the 90-day, okay, not carry a balance, and then on your 90th day, your 4th cycle, you'll be back in the grace period. And everything you make from here to your 120th day will start over just like this. Okay? So you don't want to lose your grace period whenever possible. And you can do that by understanding how much your bill's going to be when it gets there. Okay? So let's talk about interest. Really simple way to calculate interest, okay? I'll give you a down and dirty way. Okay? And this will help you with deciding if that thing that you want to buy is really worth it. Okay? So let's say we've been saying you had a 15% interest rate so far. Okay? So 15% is the same as the decimal 0.15, right? So you want to divide the rate by the number of days that the rate pertains to. Well, this is called an annual percentage rate. This is an APR. All right? So if you left a balance on there all year, this would be what you were charged for the entire year. Okay? This is your APR rate. So you just want to take that and divide that by 365. Okay? So we're going to bring the calculator in the mix here. And we're going to take 0.15 and divide it by 365. Okay? Whoop, hold on. 0.15 divided by 365. It's going to give you this big, long exponential number here. Okay? See how it's got the E at the end? That's because it goes on for more and more and more. Okay? So this is what it's going to give you, and this number is going to be your daily interest rate. You then take your balance that you have every day and you divide it by, or you multiply it by what your balance is. So we've taken 15.15 divided by 365, and let's say we have a $40 balance because we spent 10, 10. We have a $40 balance. Okay. If you choose to carry a balance, they're going to charge you this times $40. Okay. So it's going to be 1.6 cents a day. Not a big deal, right? But then you multiply that by 30. Okay, now you're at 49 cents. Now this doesn't seem like a big deal. You only owe $40, okay? You only owe, 49 cents and you only had a balance of $40. Not a big deal, right? But it's still interest. So we're going to see how it really adds up in here in a second. Okay? But that's all that you do. You take your APR and you divide it by, you turn into a decimal and you divide it by the period that it's covering. And you will get a number. Take that number, multiply it by your balance. So this was 410. Multiply it by your balance that you're going to carry every day. And that will tell you how much interest you will pay. So now you spend $40 and you carry this balance for 30 days. You just add $40 to it. That's going to be your statement balance that you get from the bank. You're going to owe them $40.49 if you decide to carry a balance. Okay? So that's real quick, down and dirty. Okay? If you didn't get that part, rewind it. It's really simple. So if you say you have this thing, say you have a $500, say you bought something for $500. Okay? Show you how significant it can be. It's on sale though. It's on sale from, you're getting 10% off. So it's normally $550, but right now it's $500. Okay? But you don't have the money to pay it. It's going to take you 3 months to pay that balance off. You're going to make $100 a month payment on it. Okay, so what's going to happen on that first month? Well, at 15% interest, you're going to be dividing that by 365, multiplying that by 500. Okay, so for the first 30 days, it's going to cost you 20 cents a day. So let's multiply that by 30. That's going to be $6.16. So when you get a balance, okay, you're going to add your 500 to this. Your first balance, your first statement is going to be 506. 506.16. I can expand this here. Okay, you're going to make a $100 payment. Okay, your next balance is going to be 406.16. Okay, same thing. You're going to take that, divide it by 365, and you're going to multiply that by this balance, 406.16. That's going to give you that times 30. Okay, 406.16. Okay, so this is going to be 411. What does that say? 411.16. Okay, you're going to make a $100 payment. It's going to take you to 311.16. Okay, so we can follow this logic all the way down, and you can see that that the interest is going to be adding up. Okay, right now it's on a ton because it's only $500. But if you take 10 months to pay this off, okay, come on. If you take 10 months to pay this off, and let's say your interest because it's going to be falling, it's going to fall as your balance comes down, and we're going to discuss average daily balance here in a second. But let's say that it's now $30 in interest after it's all said and done. Okay, you didn't pay $500 for this. You paid $530 for this. Okay, so you didn't get 10% off. You got such a great deal you had to swipe your card that day. Okay, you didn't get 10% off. You got what is that? 4% off. Okay, is it worth it now? Probably not. Okay, and the bigger this purchase, the less you're going to be getting off if you can't pay it off right away. Okay, so we're going to go to the last part of this, and we're going to talk about average daily balance. We're going to talk about how they calculate your interest. Okay, so down here on the average daily balance, you're going to start with the same month. You're going to start at day 0, and you're going to go to 30. Okay. On day 5, you went out with friends. Do this. Day 5, you went out with friends. You swipe your card, $50. You went to a dinner and a movie. You paid for yourself. You know, just hanging out with friends. Okay. On day 10, okay, you saw a pair of shoes that you absolutely had to have. You spent $90 on it. On day 15, okay, you spent. Why do I keep doing that? On day 15, you bought some concert tickets that for 6 months out. Okay, so you bought a $150 concert ticket. On day 20, you paid for lunch with your card, $15 more. Okay, so this is you on 1 month. Okay, now how your interest is calculated is, let's say that you did this all in 1 month. How this is calculated is they're going to charge you what your balance was on average for the day. For the day of the month, they're going to take your interest rate and they're going to multiply it by what your balance was at the end of all these days. Okay? So for right now, I want you to forget all. This is just like an example, okay? But we're gonna make it more simply because I don't want to do all that math. So this is an example of how it would happen. But let's say it happened like this. Let's say in the middle of the month you went and you bought a TV. You went and bought a TV for $600. Okay? They're going to charge you. It's going to be $600 times 15 days. Because for 15 days, you had a balance of $600. Okay? Does that make sense? They're going to also charge you $0 for 15 days. Okay? And then they're going to divide this by the total number of days, so 30 days. Okay? So you've got 600 multiplied by 15. Do that real quick here. 600 times 15, $9,000. Okay, and we know that this is 0. And so you're going to divide this $9,000 by 30 days. Let's put a division there. Okay, you're going to divide this $9,000 by 30 days. Divided by 30. Your average daily balance is going to be $300. Okay? So that is what they're going to charge you for per day at your interest rate. They're going to charge you at a $300 interest rate per day because you bought this TV on the 15th. You didn't spend any money the first 15 days. You were a good boy or girl. But on this last 15 days, you bought this and you carry the balance all the way through. Okay? Okay, so let's do the math on this. Okay? Let's do it the way that I taught you at first. Okay, the down and dirty way. Take your interest rate divided by 365. So you're gonna have your interest rate of 15%, 1/5 decimal, divided by 365. Okay, that's your interest rate. Multiply that by your balance, which is $600. Okay, that's 24 cents per day, 24.65 per day. You owed that amount on this balance for 15 days. So you multiply that by 15. You're going to have to pay them an extra $3.69. Let's say $3.70. Let's round up, okay? So $3.70 interest you're going to owe them based on how I told you how to calculate it up here, okay? But let's see what the average daily balance method is, okay? Because they're going to take this. You owe them $600 for 15 days. You owe them nothing for 15 days. They're going to add those together. They're going to divide it by the total number of days. Okay, this 15 and this 15 make this 30 days. Okay, and that's going to be your average daily balance. So let's take your same 15% interest rate. Let's divide it by 365. Okay, same number. Let's take that, multiply it by 300 because that's your average daily balance, right? And then we're going to multiply by 30 days because they're saying on average for 30 days you had a $300 balance, okay? And we're going to multiply that by 30. Same number, guys, 369.8. You guys see that? And we're going to round that up. So 369.8, same way. But that's how they arrive at that, okay? So what I've just done, I've taken the mystery out of interest rates. I've taken the mystery out of grace periods. I've shown you how they calculate your average daily balance. I've shown you how not to get trapped in that cycle of paying, buying something that you can't afford right away and leaving a balance on your card. I showed you how detrimental that can be to you getting out of debt and how it's going to cost you more. So, I love a spreadsheet. I love an old nasty piece of spreadsheet, right? So I did make you guys a spreadsheet to kind of drive this point home. Okay, this will be available for download in the link below in the description if you just want to play around with it. Okay, so this is a spreadsheet, and this is everything that we just talked about here. Okay, all those items, they're right here. Okay, so let's say that on day, I'm sorry, I didn't want to do this first. So if you bought another version of you waited until, let's say 10 days later, you waited until the 25th day to buy this TV. Well, now they're going to charge you $600 for 10 days, which is $6,000, right? We agree with that. We don't need the calculator for that. And then they're going to charge you $0 for 20 days. I'm sorry, that's wrong. That's wrong. My bad, guys. See, I do need a calculator. 25 for 5 days because you had it from the 25th day to the 30th day. Okay? So they're going to charge you that. That's $3,000. Okay? And then they're going to charge you the $0 for 25 days. Because for 25 days, you did not have a balance. Okay? So they're going to add that together. Okay, they're going to add that together. And they're going to divide it by 30. Because there's 30 total days here. Okay? Your average daily balance, 3,000 divided by 30 is $100 a day instead of $300. Okay? So now you do the same calculation, 15% divided by 365. That's how many days are in a year. Okay? Multiply that by 100. Okay? And you carried this balance for 5 days. Okay, so you're only going to owe them 20 cents. Did I do that right? Let's do that again. 365 multiplied by 100 times 30 days. Yeah, I thought I did that wrong. Okay, so 123 now in interest. $1.23 in interest. So by you waiting an additional 10 days, okay, you cut your interest in half. Does that make sense? Because you didn't have a balance. You didn't carry a balance for as long as you did here. You carried a balance for 10 days less. Okay? So that's how that works. So let's go back to the sheet now. No. Where's the sheet at? There it is. Okay. So, getting back to this is going to be month 1, and these are the days in month 1, okay? So, like I said, let's say on the 5th day you went out to dinner with your friends, you spent $50, okay? Look at how all this changes on the side here. The 10th day of the month, you had to have this nice pair of shoes, okay? The 15th day of the month, you bought this concert ticket, okay? The 18th day of the month, you went to lunch with a friend, spent a little more than you should, okay? The 23rd day of the month, you went out to see a movie. Just a movie this time, no big deal. And yeah, this is how much movie tickets cost nowadays. And then, let's say on the last day of the month, your paycheck, you're waiting on your check to come, and you got to fill up your tank, so you spend $35 on gas, okay? So, your average daily balance, okay, based on how I told you to calculate it, it's going to be $233, okay? This is assuming that your interest rate is 15%, okay? Your total monthly interest on this is going to be $2.47. All of this adds up to $357. So you take all your purchases, you add your interest rate, and this is what you are at. Okay, now we talked about the minimum payment. Okay, the minimum payment is going to be 1%. Okay, I made it 1%, or $25, whichever is greater. So $25 is definitely greater than 1%, right? So you're going to have to pay the $25. You're not going to get away with paying $357, okay? So you got to pay that $25, and that's going to drop your bill or be applied to your bill. So let's beef this up a little bit. Let's try to make the average payment more than $25, so you can see what I did on this sheet here. Let's say you spent $700 for some weird reason. Still not more. Let's say you spent $7,000. Okay, there we go. So your minimum payments now is going to be $73, and as you can see, this one toggles off. So when you're using this sheet, if your minimum payment is more, this is going to toggle off, okay, because you're not going to pay this. You're going to pay this because your minimum payment is more than the $25, okay? Well, let's go back, and you can see that. Okay, so this is your total interest. This is your statement balance. You're going to have to pay this. So let's say you make a payment. Let's say you can only make the minimum payment, okay? Because all of this stuff is just extra consumption by you. You're just making extra bills for your future self. So let's say you can only make a $25 payment. So you make this $25 payment, and this is going to be your new balance. Let's make that a little bit bigger. Okay? This is your new balance right here, guys. Okay? What happens now to your new balance is it carries over into the next month. Okay? It carries over into the next month. What you don't pay them, okay, you now owe them interest on for the next month. Okay? Does that make sense? So now we're going to go to month 2. You have a similar spending pattern in month 2, except you know you owe money, so you're waiting a little bit longer, but you have that girls' night or guys' night out, still $50. Okay, you just wait till the middle of the month to do it. You don't need concert tickets, you don't need shoes this month, but you did see a new shirt that you wanted. It was only $35. No big deal. You got it, right? Okay, you go to the same movie, and let's say you've been really good this month, you thought, so you go out and treat yourself to lunch 2 times in the last week of the month. Okay? So your average daily balance now, because you carried over a balance, it's now going to be more. Okay? It's now going to be more than it was last month. So what does that mean? You're going to pay more interest. So now your total interest this month is $483 instead of $247. Your statement balance now is $467 instead of $357. Okay? Your minimum payment is 1% of that is $4, but you got to make that $25 because it's an either or, okay? Whatever is greater. Okay? So you make that $25 payment. Now your balance is this. What happens to this balance? Well, you guessed it, it carries over. So you guys get where I'm going with this, right? Check out what happens, though, even if you don't spend another dime. Say you're all gravy this month. You don't spend any more money on anything this month. Okay? Your interest is still more because you carried this balance from day one. Okay? Because you no longer have a grace period. Remember, when you carried this balance here, everything that you spent from here on was charged interest immediately because you didn't have a grace period. Okay? So here, look at the interest here. Look at the interest. It's just going up. So you make your same $25 payment. It's the best you can do. You didn't spend anything. And lo and behold, you've lowered your balance a whole $20. So imagine getting charged this $5 every month. And this is very lenient, guys. Most people have, the people that my friends usually, before I, sit them down and have this conversation with them, or they come to me for help, they're just like this. But they're worse. This is thousands, okay? And they're just like, oh my God, I can't believe I got into this trap. Well, you got to figure out how to get out of it, okay? And the first thing you got to do is stop spending money on your card, because everything that you're being charged now, okay, it's being calculated immediately for interest. Okay, so I'm gonna make this sheet available for download as an Excel file. If you have any issues, download it. Please leave me a comment. This will be it on credit card interest. Guys, I wish when I was 19, 18, and credit was easy and banks were just throwing cards my way, I wish I knew this stuff. It would have saved me a lot of heartache. It would have saved me a lot of years of being a pariah, where you walk into a car, lot and get laughed off because they wouldn't even give me a car that they would come and repossess in a month because I didn't make the payment. They wouldn't even go through the trouble. They'd be like, you ain't making this payment. Your credit's so bad. Now I can walk onto a lot and buy whatever I want. Right? So this is a powerful thing. And this is what I really want to teach on this channel, because when you understand personal finance, you can relate it to anything. You can relate it to trading. You can relate it to risk reward, opportunity cost, which we're going to go over in another video. You can do all of that stuff. But you have to start with the foundations. Okay, so This will be Personal Finance 2. Thank you guys for watching. If you could give me a like if I explained it well, or leave me a comment if something you didn't understand, and maybe I can go over it in the comments. And I hope you enjoyed it, and I will see you in the next video. All right? All right, peace.